Today we're going to be talking with my good friend Jack Hollander and about strategies that he is a professional in and alternative investments and just a couple of things about tax strategies that are available. I get questions all the time about what can I do to save taxes, and a lot of times we end up saying, well, there's these more advanced strategies, and beyond the typical 401k, retirement plan contributions, buying certain real estate, doing cost segregation. There's more advanced things like alternative investments, oil and gas, and just to let you guys know, this is just for informational purposes, for educational purposes. Reach out to your strategist. You can reach out to me. You can reach out to Jack when it comes to our different expertise in this area. So I wanted to just let Jack introduce himself, and let's talk about it.
Thank you, Mo. I appreciate the opportunity to chat with you today about some alternative tax mitigation strategies. I am New York based. I am a tax lawyer by background. I went to Brooklyn Law School. I have a LLM in tax out of NYU that goes way back when. I started my career at a company that was involved years ago in what was called real tax shelters. So I bit my teeth in the world of partnerships, syndications, different types of investment opportunities, be it oil and gas, real estate, satellite deals, all kinds of things that were able to pass through deductions to people from a tax mitigation standpoint.
Awesome. Wow, lots of history and experience over there. So I guess we'll go for it with a couple of questions, unless you have a specific thing that you want to go through. But in terms of alternative investments, or if someone's coming to you to advice on this, how would you approach it? What are the things you would offer? Why would someone want to invest in something like an oil and gas rig investment? When should they do it? What's the plan? What's the whole advisory part of it to make it exciting?
So that's a pretty much of a loaded series of questions there, but first and foremost, tax planning by nature with a tax professional should take place year-round, because very often it gets late in the year, people are working with their tax professional, preparing their tax return, and they're like, hey, is there anything I can do to lower my tax liability? And that's not the right time that somebody should be looking at something that's different for them. It's not a stock, it's not a bond, it's not an ETF. These are partnership type investments. They're illiquid by nature. And so they come with a whole set of different risk reward profiles, if you will. And people need to really digest all of this information. And therefore, learning during the course of the year is really important so they understand. But people also need to be able to communicate with their tax professional about what makes up the source of their income. What I mean by that is people have W-2 income, they have dividends and interest income, they have capital gains, they have passive income, they have self-employment income, they have qualified income. So there's all different sources of income. And from a tax standpoint, what I find people don't really recognize the way the tax code works, meaning that ordinary income is offset by ordinary deductions. Capital gains is offset by capital losses. Passive income is offset by passive losses. Things of that nature. So when discussing with a tax professional, doing a tax return, financial professional, trying to determine what can I do to lower my taxes, it's important to understand what is the character of the income. Is it W-2? Is it portfolio? Is it capital? Are you doing a lot of real estate and therefore it's passive income? So this is a really important consideration to help somebody understand And for us as a professional, what might be the best solution from a tax sheltering standpoint, if you will?
Right, 100%. And people often don't really know what they're dealing with. They just know that a lot of times, what in my experience, either it's a client or mostly prospects. They come in and they say, "I paid $500,000 of taxes last year," and they're calling me because they see me all over the internet. I'm a tax strategist, CPA, and I put all this content out, so they'll book a call, and then their biggest concern is, I don't want to pay a $500,000 of taxes. And their accountant that they're using now usually is, they're doing the basics like the 401k, defined benefit plan, but they don't think that their accountant is thinking out of the box, so they come to me and but they don't really understand a lot of like the stuff that they're reading on the internet. They hear about real estate, they hear about oil and gas, they hear about cost segregation studies, short-term rental loopholes, and they don't really know like a passive, active. They get in trouble sometimes. They do a little stuff themselves, and then you get to the end of it, and now they can't even take that loss because it doesn't really work with the business income or whatever income that they had. So it's 100% a very good point.
Yeah, no, I totally agree with you. And that's why it's important for someone like myself to keep working with you, colleagues that you have, other tax professionals, because I can't expect you to do my job, right? You can't be the expert in everything, like I can't be an expert in everything. And to your point, on the internet, you see all these people out there, hey, your CPA, he does a tax return, but he doesn't do this, and you're missing all these kinds of deductions. That's one aspect of tax planning, but we're talking about an investment opportunity that during the course of the year has different implications. And what I mean by that is there are certain investment opportunities like a 1031 exchange that defers the capital gain derived from real estate. There are opportunity zone investments. Those can defer a capital gain, but that capital gain can come from any asset sale, not just real estate. Then they're dealing with bonus depreciation. So, that can create an active or a passive deduction, if you will. Oil and gas can create an active or a passive deduction. And so there are all different ways of, coming up with solutions for people. But again, it's information gathering at the outset. And then again, it's gathering education, gathering the information from an educational standpoint to apply the right strategy to what the client might be looking for.
Right. So I want to talk a little bit more about like the oil and gas specifically, and let's peg it on someone who called me recently. It's a prospect, and I think he's working in like Airbnb type business, and he's making a lot of money. He has an S-Corporation. He's active. That's the only thing he's doing. His wife doesn't work, and he's $500,000 of taxes that he doesn't want to pay, and he's already doing all the 401ks. So we know his income. After we studied the income, it's active. His S-Corp active income, and he doesn't know much about real estate. That was one of my things, buy real estate, have the wife be actively involved, and then you can probably get a lot of deductions that way. But he doesn't know anything about real estate, even though he's in the Airbnb business, but he's more like a broker. So now I told him, well, there's these alternative investments, or I kind of mentioned it, and this is kind of one of the reasons why I reached out to you, is to start my journey of really learning more and more about it, so we can explain what it is, and people could understand. Should they do it? Should they not do it? Call Jack. So he has his active income, and he's got big numbers. He's got $500,000 of taxes, so you can only imagine maybe he's making $2-3 million. So what kind of oil and gas investment would you think would work? How does it work? And the biggest question I want you to get to at some point is it a great investment or not? Like, should he put his money into something else? That or something that's not tax saving as much, but maybe over time the SPY, I'll just put money in an ETF. So a lot of people have that question. I had a question also with another guy, also trying to save money on a huge gain or some kind of income, And he kept on questioning me about what about this oil and gas? What's the risk? Are you just saving taxes and then just that's it? That $100,000 that you just put in that thing, it's like it saves you, reduce your taxes, but that's it. Like, what's your rate of return? So I want to learn more about that.
Okay, so there's a lot to talk about here. So let's just start with the basics. And let me just say this, that with oil and gas, what makes it very unique, and again, I always tell people it's not for everybody in a book of business. Be very clear about that. This is not for everybody. It's not like you have a client base and everybody puts a little bit of money into this type of investment vehicle. Doesn't work that way, should not be thought of in that regard at all. But what makes it unique, to your point, when people have high income for a current year, okay, oil and gas is something that can be considered, but keep in mind from an investment standpoint, when you're looking at an investment in a security, it's not for everybody. Again, there are certain parameters that somebody has to meet, meaning they have to be an accredited investor. Okay, so by definition, they need $1 million of net worth excluding their home, or it's an or test, not an and test. They need at least $200,000 of income for the last 2 years if they're single and projected to be this year, or $300,000 if they're filing a joint return. Okay, so if they meet that definition, they're accredited, and it's determined that it's in their best interest to invest, and they're suitable. It's a suitable investment for them. Okay, then we can start broadening and say, okay, let me tell you who this can work for. So high income, W-2, self-employed, getting a big bonus, getting stock options, anything that's going to create a significant tax advantage or taxable income, that's when people start saying, hey, how do I shelter this kind of income? Required minimum distributions. Roth conversions is another example. Taking the IRA and converting it to a Roth IRA, there's income associated with that. All of that can be sheltered. The reason it can be sheltered is the deduction that's generated, and I'll get a little bit more into it, how it works. The deduction that is generated winds up as an above-the-line deduction. So you got income, deductions to get to adjusted gross income. This will wind up in an oil and gas investment as being an above-the-line deduction because you have all that compilation of income on the return where a deduction you get to adjusted gross income. And that's why people will always say you can shelter any source of income from an oil and gas investment. And one should not just look at saying, hey, if I'm doing a Roth conversion and I'm generating $100,000 of income or $25,000 of tax liability, whatever it is, I want to just shelter that. It's not isolated to sheltering any one particular source of income. You're looking at the return in totality, and this is an item that goes on the return, again, to adjusted gross income. Okay? Now, typically what happens is with an oil and gas, there are expenses called intangible drilling costs. Those are the majority of drilling costs. They are tax code defined. Okay, so you think of clearing the land, mapping the land, making roads, a pad, bringing in the rigs, drilling the hole in the ground, fuel costs, wages, everything that's an expense that's not subject to depreciation. There's no salvage value from these expenses. And when you're dealing with a partnership investment, you can pass those through to the clients and they take that, their pro rata share of intangible drilling costs as a deduction on their tax return. Typically, in these oil and gas investments, because this is the majority of a drilling cost, 70+% of an investment amount, and it could be 80%, 90%, in some cases it could be 100% of the investment amount is allocated to these intangible costs. So let's take 80% as an example. Someone puts in $100,000, they're going to get roughly an $80,000 deduction this year to be included on their tax return. Now, how is it active versus passive? For that, we look to Internal Revenue Code section 469C3B, or C3A rather. Under that code section, when somebody is a general partner, they are perceived to be at risk as a general partner. the pass-through of those intangible drilling costs is an active deduction. It's not passive. Okay?
Regardless of whether you're actually working.
I'm sorry?
Regardless of if you're actually working on that investment.
There's actually one of the code sections in 469, I believe it's 469C4. You do not need hours of participation like you do with real estate. Yeah, once you're a general partner, you're a general partner. How do people become a general partner? When they subscribe to a particular partnership investment, there will be a box that says, do you want to be a general partner or a limited partner? Check the box that says general partner. Now you're a general partner. So when you get that allocation of your share of the intangible drilling costs, it will go on the tax return as a non-passive item. If somebody was to check that they want to be a limited partner, which they have the option to do, they get the same percentage write-off, in our example 80%, but it will be a passive loss for purposes of treatment on the tax return, and therefore can only offset passive income derived from other sources.
So is there a reason why someone would choose passive versus general? If it doesn't general always, it'll always just decrease everything? Or what will be the reasons? I think I'm already thinking the answer, but with maybe NOL limitations. But
actually, and that's a great question, why choose active versus passive? And really the reason for that goes back to what I said, that they're a general partner, they are at risk. Okay, that's the nature of being a general partner. They could be called upon to pay expenses, liabilities of the partnership not covered by insurance or otherwise. 99% of people go into a oil and gas program as a general partner. Why? Because they want to shelter income. However, and that's why we ask the question, if you have passive income, there's no reason to be a GP and have that emotional side of it of being a general partner. You get the same write-off, just be a limited partner, and you'll get that 80% write-off and offset that passive income.
Right.
Which would, and I will tell you, I've been doing this for 35 years. I've raised a lot of money in oil and gas. Never, ever, and I always say this, never, ever, though we always say, don't ever say absolutely never. But in all my years of experience, I've never, ever come across a situation where an investor is held liable for liabilities of a partnership because they were a general partner. So there are people that will walk away and say, I'm not going to do this. I'm not going to subject my net worth to be a GP on something like this. Okay?
Right.
But people, in my opinion, it should not be a concern to prevent somebody from investing. I will tell you that those programs that I'm affiliated with, that I know of, they carry sufficient insurance. Subcontractors have to be properly insured and bonded. You have assets of the partnership that could be sold eventually. So you can generate a lot of assets or income, if you will, should there ever be, knock on wood, a liability. You don't want to see that, but you have resources to cover any potential liability before you even come close to a general partner. The other thing that most of these companies do, after the first year, 2025, and the write-off is secure, then next year, because now you're just generating income, they'll automatically convert you to a limited partner status, because now you're just getting income. There's no reason to be left to be a GP. But I have to remind people that even though you're converted, okay, if something happened 3 years later, it's like if I have a car accident today and I get sued 3 years from now, I'm liable for the accident that happened today.
Right.
So if there was a liability issue that happened today, you're converted to a limited partner status, it doesn't solve the problem because you are a GP at that point.
Going forward, anything.
But again, I don't like to or beat the horse to death on this, but it is something that needs to be addressed, and people understand they do come in as a GP, they're at risk. You ask about risk, what a potential risk. Here's a potential risk from just being a general partner status, if you will.
Probably say you got to talk to your lawyer. If anytime you do anything, you should have a lawyer. Talk to your lawyer if it's something that you want to get exposed to, essentially.
Well, it's funny you say that, because very often people are dealing with their CPA, their tax professional, say, hey, you need some write-off, you want to shelter income, things like that. We give them the information, we give them code sections and all that kind of stuff. And the CPA world, the tax professionals, they get it, they understand it, they know how it works. And I would say to people, this is not a high-risk audit risk profile, if you will. I don't hear very often people getting audited because they're a GP or anything like that, or in an oil and gas deal. If you start talking to lawyers to try to figure out if it's a good investment or not, to your point, they want to understand what the risk is. They're not as interested in the tax side of it. They want to know where you could be liable.
So they might nix. Are you trying to say they might nix the deal or something, or it's too hard for them, or they might charge a lot of money to really figure it out because they'll have to really dig deep into it?
It's again, when you tell somebody there's a liability potential, they want to understand it, how they're covered by insurance protection or otherwise. So, but it's a fair question to ask about that.
Okay. So, and you did mention over there that the first year you got the deductions, but then the second year you start making income. So you might have been on your way to go there, but that's interesting. Like, how does the investment work? You start making money in the second year. Are you guaranteed to make money? Is there a risk in that? Now, I guess talking about the investment itself, okay, you got your write-off, you got a great deal, you put that money somewhere else, you put it back in your business, but now you have this investment. So let's talk about that.
So no one's investing in just one well in a partnership. There are typically multiple wells. With these wells, they're in an area where other wells have already been drilled. Because one of the questions people always ask is, am I going to have a dry hole?
Yeah, that was a question I just got.
What's coming out of the ground? And, the experts will always say, how do you know to drill here for oil? And they go, well, that's because we drill where the oil is, right? How do you know that? There's a surrounding area where wells have been drilled. And there could be thousands of wells, literally, in Texas, different areas of Texas, the Dakotas, in Pennsylvania, Ohio, West Virginia, Oklahoma. People have been drilling for decades in this country. So we're not wildcatters. There's no exploratory. No one's looking to be the first one to drill a well in an area that's no one ever drilled before, because that's where you have the real risk of a dry hole. So it really is a manufacturing business today that the expectation, even though you can drill a multi-million-dollar well that goes 10,000 feet vertically and 10,000 feet horizontally, could cost $7, $8, $10, $11 million. But the expectation from an investor standpoint, you're going to find some level of production. Okay? And again, in these programs that people will go into, they'll participate in multiple wells. So you're not the only investor in one well. You're going to be a participant with others in many wells, so you have some diversification, because not every well is going to be exactly the same. They'll perform a little differently. Some may be a little not produce as much. Some will produce more. Okay, so on average, you have a good idea, in learning the history of the operator, what the expectation is from a revenue standpoint, how much production is expected. And there are wells that will produce mainly oil. There are wells that may, in like Pennsylvania, produce mainly natural gas. There are wells that can produce a combination of the two. Okay? But from a structure standpoint, if you're looking for the write-off, that's what you'll get about an 80, 90%, whatever it is, write-off. But someone say, hey, I may want to be more natural gas than oil. Okay, well, here's a company that can do that. I like Texas. I want to be in Texas. So we get them opportunities to be in Texas. So the well gets drilled, and again, we're starting a new business to find oil or gas production. Okay, we drill the well, we pass through the drilling costs to the investor. So while the majority of the cost represents intangible costs, a portion of the cost goes to equipment that'll be subject to depreciation, and in today's world, 100% bonus depreciation is applicable. Okay, so there's an added benefit of depreciation there. So now we're finding oil, natural gas, maybe natural gas liquids with it. I always tell people the way you look at it is it's like inventory in a warehouse. The warehouse is filled to the top day one. Every day we're going to be selling some of that inventory. Okay? The way a well normally performs, and this is on average, obviously, the way they perform is that maybe 45 to 60% of lifetime production, and a well can produce literally for decades, 20 years, 30, 40, 50, 60 years. Okay? That's not uncommon. But you can get 45, 60% of lifetime production in the first 2, 3, 4 years, let's say. We call that flush production. So if you're going to have more production early on, okay, and then the rest of that production is going to take decades to come out of the ground, you're going to have really good distributions, double-digit distributions from a revenue standpoint, cash flow standpoint early on. And what I tell people to do normally, you get the good write-off the first year of the investment, and then work with your financial advisor to take those distributions that come out, because they really are a return of capital until one gets all their money back, and invest it in things that are suitable for the portfolio. Doesn't have to be this. You're not going into the same partnership. Maybe a different partnership next year when you want more write-off. But buy something else, insurance premiums, stocks, ETFs, real estate, whatever you like to do for your portfolio, take the money and invest it in that regard. And one other added benefit about oil and gas is that there is a depletion allowance. 15% of revenue derived from the wells, it's actually gross revenue, is a deduction every year as long as the wells produce. So if you got $100 of revenue, $85 is subject to tax, $15 will be a deduction on your tax return. And again, how long is it going to take to get your money back?
Yeah.
Tell people you got two ways to look at it. Strictly cash on cash, how long until I get all my money back, just from the distributions, and then cash and tax. Because if you get an 80% write-off and you're in the top tax bracket, and that could be New York where the deduction is allowable in New York State, okay, you may be 35, 40, 45% tax savings, and then you're getting your distributions. But at the end of the day, these do make money. It's a question of how much will you make, because again, you're asking the question, what's the greatest risk for all this? The greatest risk is really commodity pricing. We know oil prices go up, they go down. Natural gas prices go up, they go down.
Right.
Okay, so that's the greatest risk. Now, companies will hedge, so they'll lock in prices. Maybe they're giving some of the upside, not taking advantage of it, but they want to protect some of the downside. But they're never going to hedge 100% of potential production, because you want to have some market flexibility as well. You know, there's obviously a lot to all this, but you get a good write-off the first year. This year, there will be revenue going forward, and one anticipates having that flush production, double-digit production, if you will. You know, one of the things that people always ask, though, but how quickly can I get my money back?
Yeah, I'm thinking about asking you right now.
If you do a one-well analysis, just look at one well, an operator will tell you it may take 2 years, 2.5, 3 years to get all your money back. But I tell people, if you have multiple wells in a program, they don't all get turned on at the same time.
They're still digging, or they're...
So, and it may take, from an investment standpoint, it may take 6 to 9 months to drill a well. Then you got to get the production, you got to sell it, you got to collect a receivable, you got to do all your accounting. So by the time you start getting distributions, right, so maybe 5, 6 years, cash on cash, you could have 100% of your money back. If you do factor in the tax savings, could take 4 years, 5 years. But then you're going to keep getting checks down the road thereafter.
Do people, are you able to sell them whenever you want, or how does that work? What do people end up doing in average? Like,
in average, they sit, because it's a partnership, limited partnership investment, there is no readily available secondary market. Okay, so the expectation is you're going to hold on to this for a long period of time. Keep in mind, one day the inventory in that warehouse is gone. This is a depleting asset. It's not appreciating. Nobody should go back to their financial advisors or me or you, whomever, and say, hey, give me all my money back, okay? Because there's less inventory in that warehouse. It can't have the same value as day one. So people typically hold on to these, though at some point an operator may take all that income producing and try to sell it to somebody else who may have an interest just to have some sort of portfolio of income producing assets.
So like 10 years, you'll probably get a final K1, or is there like a any kind of average? Like you're gonna get a final K1 at the end, and that's it. You're done. You got your money out. You got your tax savings in the beginning. Is there
Yeah,
like an
could be
average
10,
year that
15,
someone's gonna?
some companies understanding the need, the wanting to have some liquidating event. But again, it's a partnership interest, and so there's no readily available secondary market for partnerships like you have for stocks. And so, you're up to the choices of the operator as to what they think is in the best interest of the partnership to do.
And if they do they ever run out of money and they have a capital call and those kind of?
No, they may put in their offering material that they have the right for a capital call, but anybody that would have a capital call, they're never going to raise money from investors again.
Oh my, yeah,
So typically, the manager, the operator, the real general partner, if you will, they say that they would be responsible for any overages or anything like that.
a very good point. Awesome, wow, this is really really educational. I'm learning more and more about it each day.
Well, the issue with this, we have this conversation, and people have the discussion, they understand it, they nod, they shake their head, and then tomorrow they're like, okay, I got a bunch of questions now. I got a refresher. I got
Well,
to think
that's
this
yeah,
through.
that was kind of the point of this podcast. I don't know if there's that much information out there on the internet, and hopefully this will help a lot of people understand. There's a lot more to even talk about. One of my questions, you mentioned state, and I don't know, from your experience, you mentioned New York that you can still get these deductions. Have you ever seen or heard that certain states do not allow this deduction?
I
They can
know in
add back.
I know in the last few years, California actually did have was not as much in favor of it, if you will. I think now they may require it to be amortized over 5 years as opposed to expensing it. And that is one thing that the IDC deduction, pursuant to the Internal Revenue Code, okay, you can expense, take what you need in the current year. Most people will take 100% of that IDC, or you can amortize it over 5 years.
It's like an election.
It's a taxpayer election, not at the partnership level.
Yeah,
And,
yeah.
and, and the other thing that I do want to mention, because you'll hear as the year goes on, gets closer to year end, and people talk more and more about this, and then the question is, how can one create such a large deduction so late in the year? And the answer to that is, and again, all this is in the tax code, that as long as these intangible costs are prepaid by year end, and as long as the drilling starts, not completed, but the drilling begins by the end of within 90 days following the close of the tax year, the write-off is good for the current year.
That's not important.
And it's important, and that's why there's advantages, and people do wait too long, and an oil and gas company doesn't like to wait for their money to come in and have all that pressure and, wait, I only got 90 days to start drilling. The more money that comes in earlier, you can have more wells in a program, and, it just takes pressure off of the company from an operating standpoint.
So from your experience, when people are, working with their accountants, and the good accountants that are always being, proactive, already have a projection. Like where I grow up, in my firms, we always know by September, October time, we do projection for the client. We know pretty much what their taxes and what their estimates are going to be for January, for the fourth quarter. Sometimes we're even projecting or planning for that, the September 15 quarter. So, but if you are not really sure what's going on in December, you have this huge, bonus, and it's like you just don't have time to really figure it out. And the accountants, sometimes some accountants like to take a vacation. So this strategy doesn't work if you wake up in January, February. Is this correct?
Correct. Because a partnership has a calendar year end. So they're closing their books as of December 31 of 2025, by way of example.
Wow. That's an interesting thing. So none of these partnerships ever end the June, July, where you can kind of have a different ending and then you get a K1. I guess that's
No,
for the future. Yeah.
they're all calendar years. So, you're planning for your 2025 taxes, and the investment's got to be made in 2025.
Yeah. So basically, if you have this gain, this issue, for all those listening, you got to make sure you invest in this oil and gas before year end. It's not gonna. It's just like retirement contributions, like from your W-2. You gotta do it before the year end. This is like it
Correct.
doesn't work. It's not like you can accrue it. So that's a very important point for people.
And again, from an investment standpoint, it's portfolio allocation, it's portfolio diversification.
Right.
I tell people all the time, I don't want all your money. I don't want to put it in oil and get all your money. But, you have stocks, bonds, fixed, variable, annuities. Portfolios made up of different things. Portfolios should include tax efficient investing. And this is a tax efficient investment. And again, it's portfolio diversification. Just part of the
Right.
portfolio, make it part of the plan, get those good distributions, and reinvest it into things you like to have in your portfolio. To me, that's the ideal
100%.
way to do this.
Yeah. I mean, and we talked about it before. You can't just sell it. You buy it. You hold it. It's not like liquid anymore. So you don't want to put all your stuff in one basket and now you're stuck. It's like putting all your money into a retirement plan. You can't touch it until you're 60. So it makes sense. You just, if you have $1 million, I don't know if there's a formula. $100,000 maybe could be the oil and gas investment, and the rest of the $900,000 is other stuff, whatever.
Absolutely. No, that's totally true. And one of the things that was not mentioned, and again, this is getting into higher earners, if you will, that are in the alternative minimum tax. And there is a certain threshold here of an investment amount that if you do not reduce your alternative minimum taxable income by more than 40%, then there is no tax preference associated with this investment.
Right? That's a
And
very
so
that's
while
that's
more
a
people,
tricky one. If you do too
that's a
much of
tricky one.
it, then it's because there's these ad backs. Wow, I can see
Right,
someone really
but
messing up there.
so that's why, you don't want to overshelter. The other advantage, though, is that if somebody is self-employed, you can reduce self-employment taxes. And that's where, again, some proper planning comes in, because people do joint returns, but only one spouse is self-employed. You want to make sure that the spouse that is self-employed makes the investment. Don't do it jointly, even though a lot of husband and wives like to do investments jointly,
Right, right.
right? Because how would you then split it up in terms of, the tax return or something along those lines? So,
Wow, you're adding a lot of nuggets here. That's a very good point with the self-employed. So I would assume, I think it's box 14 in your general partnership oil. You'll have the same number as the self-employment portion, because you're self-employed essentially.
and,
That's
and
another one.
yeah, and another one that's not even mentioned, we talked about why be a limited partner versus a general partner. If you have a closely held C-Corp, five or fewer own more than 50% of the company. It's a tax-paying entity, not a pass-through entity. It can come in as a limited partner and offset the active income of that entity.
So some C corps, you would advise them to maybe do a little oil and gas as part of that
Correct.
strategy.
Yep.
Interesting.
But the other
Interesting.
thing to mention, S-Corps and LLCs cannot be GPs. Why? They're not truly at risk. If state law limits liability, then they're not a true general partner. They're not truly at risk. So they
Right.
have the issue there of potentially, if the IRS was to do an audit, losing the benefit of being a GP, they would then be considered a limited partner, cannot offset all sources of income.
So you can't have a single member LLC or a dual member LLC or S corp invest in these. A
Correct.
trust, a regular irrevocable trust, could invest in this.
Trust can, revocable trust can, absolutely. Those
Foreign
can,
foreign investors could. do foreign investors they can invest in this too?
They can if they pay U.S. taxes.
Yeah, the ones that have like either a foreign trust or 1041 NR because they have other activity in the U.S. Foreign or a U.S. partnership.
But again, you're
Okay.
sheltering U.S. dollars, not foreign tax dollars or foreign income.
Right, right. Exactly. Wow. All right. So, did you want to shift into another one of the other things that you love talking about that are very exciting? I know we spoke about the qualified QOZ, qualified opportunity zones, that you also have an angle on.
Yeah, I think it's, again, these are further discussions, but just a couple of points to make. With 1031 exchanges, and it's a very big market, 1031 exchanges, where again, it's real estate investing in another real estate opportunity that was used in investment or in a business, not a personal residence. And one thing that people do not realize is that you can exchange real estate for mineral rights. Okay? For royalty interests, you can do that. And therefore, if there's a little bit of boot, a little bit leftover gain or something like that, or somebody wants some diversification, they can do that exchange and incorporate into their exchange mineral rights. But
Interesting.
now,
So let's,
what
you
you
know,
have
so
to
someone.
do with the 1031 exchange, you have to identify replacement property within 45 days, and you got to close within 180 days. So it's very technical, and you don't want to miss out on the opportunities and from a, do something wrong that you blow the opportunity to defer the capital gain from a real estate transaction.
So interesting. So you get let's say you have $1 million gain of your real estate, your rental property, and you're buying, a $500,000 replacement property. Now you have this extra boot. So these oil and gas investments that we were talking about is considered.
It's a different kind of oil and gas. You're buying royalty interest, mineral rights.
Okay.
You're not getting an IDC deduction. It's strictly an income play.
Interesting. And then now you have this. It sounds very, 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 very in depth. We'll probably have to do another podcast on that. But it's good to know. This is education. It's good to know that a lot of times people couldn't find the right property. They have this extra gain. So make sure you call up Jack. He'll be able to guide you that there's these mineral rights. It's real estate. It's basically another thing, but it's not really real estate. So it's probably easier to find. Right? It's probably easier to find that.
It's defined as real estate, so.
But it's easier. It's like you don't have to find a realtor. Like you just call Jack. He has a list of what to invest in because that's what
Right there, I have the sources that provide the mineral rights for this kind of transaction.
And what do you get from that? It's like a closing. Like what do you get? Do you get a K1? Like, what is the investor?
That's more 1099 because it's a royalty.
Okay, you get a royalty 1099, and okay, very interesting.
Yeah. And then you asked about opportunity zones, and again, that's another deferral of capital gains, and that can come from any source, right? It could come from your personal residence. It doesn't matter. It could come from selling stock. As long as you have a capital gain. But now under the new tax bill, the rules are changing a little bit. So investing in opportunity zones may slow down a little bit because if you invested in one today, to defer today's capital gain, 2025 capital gain, you have to pay the tax in 2026. Once you go into an opportunity zone for a capital gain starting in 2027, you can defer that gain out 5 years. So there are special rules, again, there to give consideration to, but it can create a little bit of backtracking, if you will. Opportunities where you asked the question before, can you do something from a prior year? Opportunity zones because you have to invest within 180 days. And typically if a opportunity zone fund has a partnership filing for March filing for the partnership, you can go 180 days out. So let's say someone had a gain in November of last year, okay? They may still have an opportunity to go into a particular fund by September 15th of this year to defer some gain from last year.
That's yeah. It's very. So that anyone who's listening, OBBB, the one big beautiful bill with Trump, has changed the whole opportunity zone rules, and just keep in mind that there could be a better timing to get in, or wait, but there's different rules changing over the next couple of years. One thing,
there's an opportunity if someone has a lot of passive income with bonus depreciation and certain real estate like gas stations, convenience stores, where their useful life is 20 years or less, and you add some leverage onto an acquisition there, you can create a greater than 1-to-1 passive loss deduction.
I was actually going to ask you about the gas stations, because it sounds to me like it's oil and gas, and it seems like the rules treat that as not a 39-year property.
Gas stations, right, have special rules because it falls within the 20-year useful life of how the income is calculated for a gas station.
So the whole convenience store part of the wells there.
Well, there's no wells. No, this is strictly real estate.
Wells. I used to do before I was an accountant. I was in school for architecture. I don't know if I ever told you that. One of my first jobs was working at a place that was an engineering company who basically was revamping gas stations. So part of it was the convenience store redoing, but sometimes the actual gas station, you would have all these little symbols called Monwells, and like the locate, where they put the gas in. You'll see those big pipes. So I call it Monwells. So that's what I meant when I said the wells. But so interesting. So where do people invest? Is there so you place people with gas stations as well as part of your strategy?
I have access to a particular fund. There's a track record with it that if someone's interested in something like that, certainly show them that type of opportunity. Yes.
Right, so you either have a fund, or you can just go and buy a gas station.
That's true.
It's a good tip right here.
That's
gas
true.
Stations,
Yep. Absolutely.
I think I once had almost a prospect of someone who said that they had 20 gas stations in Florida over here, and it never became a client. This was years ago, but it sounded exciting, So people do invest in gas stations, so it must be that's a nice way of writing off.
Hey, listen, I see investments, car washes, laundromats, gas
Car
stations.
washes was another one. Yeah, I've seen that too.
Absolutely. So
All right,
the point is there's a lot of opportunities out there, but people just need to ask the question as to how, what, where, and be educated on it and see if it makes sense for them to invest in these types of opportunities.
100%. So yeah, to summarize my learning of it is, first you got to have an advisor, like a CPA tax strategist that you're working with, so you can have an understanding of where you're at with your income, what kind of income you have, and then he can help you place you into ideas if you want to try to mitigate taxes. You got the normal stuff, obviously deductions, you got retirement planning, and then you got these oil and gas investments and other ways to defer your gains. And it's really it's like a team effort a lot of times, because we can't know everything. I also always tell everybody, you're a lawyer, make sure you're working together with your lawyer, so everything that you're doing has a reason for your wealth planning, trust and estate planning. Make sure that you're really doing what's best interest for you, not always just to have that thing's taxes. I don't want to pay a penny in taxes. Well, I work with a lot of rich people, and they pay taxes, probably not more than they need to, but they pay taxes, and they're wealthy. So sometimes people get into this crazy thing of, I don't want to pay taxes, so they buy something. You'll see a lot of people buy a big car, $100,000 G-Wagon, and that saved them taxes. But guess what? A G-Wagon doesn't give you money like wells do, So it's they do silly things to save money, and it really was a bad investment. It's not even an investment.
But the other thing I do want to emphasize is that, and we said this at the beginning, I do have a securities license, right? So, SEC, FINRA, it's like selling a stock, if you will, or a bond. And so I'm affiliated with a firm and anything we talk about, and again, this is an educational, meeting here that we're talking about, but in order for me to have access to anything, the operators, these companies, these funds, they have to go through pretty significant due diligence. I'm not, if someone called me up, Mo, you call me up and say, hey, I got some, we're not just going to go to any Joe Schmo off the street that's got a couple of wells and he's looking for money. Okay, we want to make sure there's a vetting process. People have looked at them, good management, track record, all that kind of stuff. That it all makes sense because that's in everybody's best interest.
Awesome. All right. So to end it, tell us how people could reach out to you if they.
Sure. Okay, Jack Hollander, J Hollander at cabinsecurities.com.
Okay.
J Hollander at cabinsecurities.com. And my phone number is 516. I live in New York on Long Island. 516-306-5820.
Awesome. I'll post that when I ask the question. I'll put that on the video, and I really enjoyed this, Jack. It was really nice to talk about all this wonderful, helpful information, and let's do it again. Till the next time.
I appreciate the opportunity. Thank you.
All right. Well, have a great day.
Okay.
Thanks.
Thank you. Thank you.